You'll hear me use the term deferred item. So these are results of temporary differences. So any of these book tax differences that we've recognized, that is what makes up our deferred. Essentially, they're deferred differences that will reverse in the future. And so the deferred tax expense is the change in these deferred items. And so each year you'll have a beginning deferred expense, or beginning deferred tax asset or deferred tax liability, and an ending deferred tax asset or liability. The change in that is what makes up the deferred tax expense. Generally, these items result from balance sheet items. So your accrued expenses, prepaid expenses, depreciation, so your accumulated depreciation, accumulated amortization. It doesn't always result from balance sheet items, but generally it does. You'll hear me refer to kind of pre-tax, post-tax. And so pre-tax, sometimes people call these gross deferred tax assets or gross deferred tax liabilities. It's not technically correct in the terminology, but pre-tax is essentially deductible temporary differences. And so if a deductible temporary difference, that results in a deferred tax asset once you apply the tax rate. DTLs are your taxable temporary differences. And so once you apply the tax rate, you have a deferred tax asset or deferred tax liability. Before you apply the tax rate, you have your deductible temporary difference or taxable temporary difference. Essentially, these are the amounts that impact your taxable income in the future. And then post-tax effect. So we always want to enact or use the enacted tax rate, not the effective tax rate. This is important because what these represent are future items, future deductions or future income items that we need to apply the proper tax rate. And so one item I wanted to kind of point out, sometimes when Congress passes a law, the timing's a little different. For example, this last go around with the Tax Cuts and Jobs Act, they passed the law prior to year end. So they passed the law in December, applicable to income items starting at the beginning of the year. So in December of 2017, they passed the law to change the tax rate to 21%. This 21% rate applied to 2018 tax years. And so there was a few week difference, and it spanned the end of a calendar year. And so when we valued these deferred items, these deferred tax assets and liabilities, we had to use the enacted tax rate. So on the 2017 financial statements, we used the 21% rate, even though 2017 tax year was still using the 34 or 35% rate. The reason for this is all of these deferred items represent future year income and deductions that would have been applied under the 21% rate. And so just keep that in mind. If there are ever any changes with tax law and the enacted rate, that's what we use. We use the enacted rate regardless of what period it applies to. Deferred tax assets and deferred tax liabilities are reported net on the financial statement. So you net them together and you report one deferred tax asset or deferred tax liability. You don't report both. And then we do need to track the character of these items. If it's an item that relates to ordinary income, we track that separately from an item that relates to capital income. The reason being is there's tax rules that limit the ability to offset certain characters of losses against ordinary income.